It's Monday morning, January 19th, 2026. I'm staring at a number on my screen that I never thought I'd see in my lifetime. $94.21 per ounce. Silver just printed a new all-time high for the fifth consecutive session, and the financial media is acting like this is just another day in the markets. CNBC ran a 45-second segment this afternoon calling it commodity volatility. Bloomberg buried it below a story about tech earnings. And if you're watching the mainstream ticker parade right now, you'd think this was normal price action in a normal market. But I've been a private commodities analyst for 12 years. I've tracked every major silver move since the post-2008 rally. And I need to tell you something that the talking heads on television either don't understand or don't want you to know. What we are witnessing right now is not a rally. It's not a spike. It's not retail speculation gone wild. This is a structural repricing of the world's most versatile industrial metal. And it's happening in real time, while most investors are still asleep at the wheel. I built this channel using an AI avatar for one single reason: speed. I got tired of waiting half a day for the mainstream media to report what I could already foresee happening on my terminal. And frankly, I got tired of watching all these other fake channels pump out recycled hype and garbage speculation when there are real people out there. Stackers, investors, regular folks like you trying to protect their savings who need actual information. Not clickbait, not hopium. Data. So let me tell you exactly what's happening and why the $94 print you're seeing right now is just the beginning of something much bigger. Here's my primary claim. Silver has entered a structural repricing phase driven by 5 consecutive years of supply deficits, totaling 820 million ounces, an industrial demand explosion led by solar and EVs that cannot be substituted, China weaponizing export restrictions, and a complete breakdown in the paper to physical price discovery mechanism. The US Mint just repriced silver eagles to $173. Let me say that again. The sovereign mint of the world's reserve currency is now charging $173 for a 1-ounce silver coin, while the screen says $94. That's not a premium, that's a confession. And I'm going to spend the next hour proving to you with data, math, and market mechanics exactly why this is happening and where it's going. Let me give you the snapshot I pulled a few hours ago. Silver spot, $94.21, up 31% in 18 trading days. Gold sitting at $4,707, up about 3% over the same period. The gold to silver ratio has collapsed to 50-1. That's the lowest level since 2012. It was 105-1 in April of 2025. Just 9 months ago, it took 105 ounces of silver to buy 1 ounce of gold. Now it takes 50. That compression isn't normal, but that's a market screaming that something fundamental has changed. Let me put this rally in context because the numbers are staggering. Silver entered January at around $71. On January 10th, it broke 80. By January 14th, it hit 91.54, and the US Mint suspended all silver sales. On January 17th, it pushed past 93, and now we're sitting at 94.21, another new all-time high. That's a 31% gain in less than 3 weeks. But zoom out further. Over the last 12 months, silver is up 190%. It was trading at $32 in January 2025. 190%. That's not gold. That's not the S&P. That's not even Bitcoin. Silver has outperformed virtually every major asset class on the planet. Now I need to teach you something that most investors don't understand because it's the key mechanism driving everything we're seeing right now. It's called the structural supply deficit, and silver has been running one for 5 consecutive years. That has never happened before in the modern commodity era. Think of it like a bathtub. Every year, the world produces a certain amount of silver from mines and recycling. That's the water coming in through the faucet. And every year, the world consumes silver for industry, investment, jewelry, and coins. That's the water draining out. In a balanced market, the water coming in roughly equals the water going out. The tub stays stable, but since 2021, more water has been draining out than coming in. Every single year, the tub is emptying. Let me run the numbers. In 2021, the deficit was 51 million ounces. In 2022, it exploded to 237 million ounces. That was the largest single-year deficit in history. 2023 saw 184 million ounces short. 2024 came in at 149 million, and 2025 is projected at around 95 million. Add those up. 820 million ounces. That's the cumulative hole that's been punched in global silver inventories over 5 years. To put that in perspective, global mine production is about 835 million ounces per year. We've burned through nearly an entire year's worth of production just to fill the gap. Now here's the part that should terrify anyone who thinks prices will just come back down. Supply cannot respond. It physically cannot. And I mean that literally. About 70 to 80% of all silver is produced as a byproduct of copper, lead, and zinc mining. Those mines are optimized for other metals. They can't just decide to produce more silver because the price went up. Their economics don't work that way. And the primary silver mines that do exist, bringing a new one online takes 10 to 15 years from discovery to production. That's not a bottleneck you fix with a price signal. That's a structural constraint baked into the geology of the Earth. Meanwhile, mine production peaked back in 2016 at 900 million ounces. It's been declining ever since. 2024 came in at 820 million. Ore grades are falling. The easy silver has been pulled out of the ground. What's left is deeper, lower quality, and more expensive to extract. So supply is constrained, declining, and cannot respond quickly. That's one side of the equation. Now let me show you the demand side, because this is where the story gets explosive. Industrial demand hit an all-time high of 680 million ounces in 2024. That's 56% of total silver consumption going to industrial applications. This is not your grandfather's silver market. This isn't about coins and jewelry anymore. Silver has become indispensable to the green energy transition. Let's start with solar. In 2014, solar panels accounted for about 11% of industrial silver demand. By 2024, that number had grown to 29%. That's 230 million ounces being consumed by solar alone. And here's the kicker. The advanced TOPCon solar technology that is becoming the new industry standard uses 50% more silver per panel than traditional technology. So even if the number of panels stayed flat, silver consumption per panel is rising. But the number of panels isn't staying flat. The International Energy Agency is projecting that global solar capacity needs to triple by 2030 to meet climate targets. Triple. That's not a forecast I made up. That's the IEA. Then there's electric vehicles. A traditional internal combustion engine uses about 15 to 20 grams of silver. An EV uses 25 to 50 grams. Premium EVs can use up to 80 grams. That's 67 to 79% more silver per vehicle. Global auto production is around 80 million vehicles per year. If even half of those transition to EVs over the next decade, you're looking at millions of additional ounces of silver demand that didn't exist 10 years ago. And then there's the wild card that nobody saw coming. AI data centers. These facilities require silver for thermal management systems, high-efficiency cooling, server interconnects, and power distribution. Microsoft, Google, Amazon, Meta, they're all in an arms race to build AI infrastructure. Every watt of computing power they add requires silver to keep the system from melting down. Analysts are only beginning to quantify this demand category because it barely existed 5 years ago. So you have demand exploding from solar, EVs, AI, 5G infrastructure, and basic electronics manufacturing. And you have supply constrained, declining, and unable to respond. That's the structural setup. That's why we're seeing 190% rallies. But that's still not the whole picture. On January 1st, 2026, China implemented new export licensing requirements for silver. They effectively turned off the tap to the West. If you want to get refined silver out of China now, you need government approval. China produces about 13% of global mined silver and is a major refining hub. This isn't just a trade policy. This is silver being weaponized as an economic tool, joining rare earths, gallium, germanium, and antimony on the list of strategic materials subject to export controls. Elon Musk commented on X that silver is essential for numerous industrial applications and that this is not good. He's right. The China restriction has immediately tightened global supply and blown out premiums in Western markets. Shanghai silver is trading at a 25 to 30% premium over London spot. That arbitrage gap is driving physical metal eastward while the West scrambles. Now let me explain the mechanism that's causing the physical market to completely break away from the paper price. Because the screen is lying to you, and I mean that literally. The spot price you see quoted everywhere, the $94.21, that's derived from COMEX futures contracts. It's a paper price. It represents what traders are willing to pay for the right to take delivery of silver at some future date. Most of those contracts never result in actual delivery. They get rolled over or settled in cash. It's a bet on direction, not a transaction involving real metal. Physical silver is what you buy from a dealer, what sits in a safe, what you can actually hold in your hand. It has mass, it has scarcity. And when everyone wants it at the same time, the price has to rise until enough buyers say no thanks. Here's where the breakdown becomes obvious. The COMEX paper price says $94, but if you try to buy a generic 1-ounce round from a dealer right now, you're paying $102 to $113. That's a 9 to 20% premium. If you want an American Silver Eagle, you're looking at premiums of 17 to 25%. In the US Mint, they just repriced their Silver Eagles to $169 to $173. That's an 85 to 92% premium over spot. The sovereign mint of the United States is pricing silver at nearly double what the paper market says it's worth. Stop for a second. Think about what that means. The paper market says 94. The physical market says 173. That's not a spread. That's a divorce. That's two completely different price discovery mechanisms operating in parallel and reaching completely different conclusions. Since October 2025, silver has been trading in backwardation. That's a market state where the price for immediate delivery is higher than the price for future delivery. In a normal market, futures are always more expensive than spot because of storage costs, insurance, and the time value of money. When that relationship flips, when people are willing to pay a premium to get metal now rather than waiting, it's a desperation signal. It's the market screaming that physical supply is tight and getting tighter. Silver lease rates have exploded from historical norms of 0.3 to 0.5% to approximately 8% by January 2026. That's a 16 to 20-fold increase. That tells you that holders of physical silver are not willing to lend it out at normal rates. They want to keep it. And that's creating a squeeze on anyone who needs to borrow metal to cover short positions. The COMEX vaults are bleeding. On January 7th alone, 3.25 million ounces were withdrawn with 0 ounces received. That's been the trend since October. JP Morgan's vault saw 1.3 million ounces disappear in a single 24-hour period. The metal is leaving the system. TD Securities issued a warning that the LBMA's free float silver, the metal actually available for trading in London, has dropped to approximately 155 million ounces. That's about 6 weeks of global demand. At current drawdown rates, it could be exhausted within 7 months. The London vaults peaked at 1.15 billion ounces during COVID. They're now down 49% from that peak. Let me tell you about what the Reddit community is planning, because this adds another layer of demand pressure that the institutions are not prepared for. The Wall Street Bets community has launched what they're calling Silver Squeeze 2.0. And unlike 2021, when they bought SLV and got caught in the paper trap, this time they're going physical only. 8.7 million users have pledged to participate. The coordination date is January 24th, 5 days from now. The estimated buying power is $41 billion. Here's the math problem they're creating. Total U.S. dealer inventory right now is estimated at around 28 million ounces. At $90 per ounce, that's about $2.5 billion worth of metal. They're bringing $41 billion in demand against $2.5 billion in supply. That's a 16 to 1 mismatch. Even if 90% of those pledges don't follow through, you're still looking at a demand shock that dealer inventory simply cannot absorb. And unlike 2021, the retail movement is now running with institutional flows rather than against them. Morgan Stanley is recommending silver as a fiscal risk hedge. Multiple Wall Street firms are raising price targets. Institutional ETF inflows are at record levels. This isn't retail versus institutions anymore. This is retail and institutions versus a physical supply that cannot expand. Now, let me steelman the strongest argument against this thesis because I know the skeptics are sharpening their knives. Counter-argument number 1. This is a speculative bubble. The RSI is at 77.9, deeply overbought. Once the FOMO fades and the margin calls hit, silver is going back to 70. Here's my rebuttal. Look at the ACOT data, the Commitment of Traders report, that shows how different market participants are positioned. Hedge funds are actually net long down 41.8% during this rally. That means speculative positioning has been declining even as prices surge. That's the opposite of what you see in a bubble. In 1980, speculative positioning was at extremes before the crash. In 2011, same thing. In 2026, speculators are actually reducing exposure while prices rise. That tells you this is being driven by genuine physical demand, not leveraged speculation. Counter-argument number 2, recession will kill industrial demand. Solar installations will slow, EV sales will drop, the green energy transition will pause. Here's the thing. Industrial demand is relatively inelastic to economic cycles. These aren't discretionary purchases. Solar manufacturers have supply contracts and production schedules. Automakers have committed billions to EV retooling. Governments have mandated transition timelines. Even in a recession, this infrastructure gets built because the political and contractual commitments are already locked in. And investment demand for silver actually increases during recessions as people seek safe haven assets. So a downturn might slow industrial demand at the margin, but it would boost investment demand on the other side. Counterargument number 3. The exchanges will just change the rules. They'll hike margins, impose position limits, force cash settlement, and crush the rally like they did in 1980. This is the one I take most seriously. Yes, the CME can raise margin requirements overnight. They did it in December, hiking silver margins by 47%. They might do it again. And yes, that would force leveraged traders to liquidate, creating a temporary price drop. But here's what the skeptics miss. You can't margin hike your way out of a physical shortage. You can shake out the speculators, but the industrial buyers still need metal. The solar manufacturers still need silver paste. The automakers still need components. The mints still need blanks. And all the margin hikes in the world don't create a single additional ounce of physical silver. The 1980 collapse happened because the Hunt brothers were two billionaires trying to corner the market. Today's buying is decentralized across millions of retail investors, industrial consumers, central banks, and institutions worldwide. You can't paint that as manipulation. You can't demonize an entire global economy that needs silver to function. Let me show you the historical comparison that matters here. In 1980, silver went from $6 to $49, a 713% gain in 12 months. That was driven by concentrated speculation and ended in regulatory intervention. In 2011, silver went from 8.79 to 49.21, a 460% gain over 30 months. That was driven by QE fears and ended with 5 margin hikes in 8 days. But here's the critical difference. Neither 1980 nor 2011 had a structural supply deficit. Neither had industrial demand at 56% of consumption. Neither had China weaponizing exports. Neither had the solar and EV transition creating locked-in demand growth that doesn't go away when the economy slows. 2026 is different. Not because I'm bullish and want it to be different, but because the fundamental drivers are different. This is structural, not speculative, and structural moves don't reverse on margin hikes. Now let me give you my personal battle plan. What am I watching? What are my triggers? And how am I positioning? This is not advice. This is just what I'm doing. You make your own decisions. Trigger number 1, the $90 floor. If silver pulls back to 90 and holds for 3 consecutive daily closes, I'm interpreting that as structural confirmation. The dip buyers are still in control. The floor is real. If it breaks below 85, I'm reducing exposure and waiting for a clearer technical picture. Trigger number 2, the gold to silver ratio at 45. We're at 50 right now. If the ratio breaks below 45, we're in what I call silver mania territory. That's when normies start asking their advisors about coins. That's when premiums go parabolic. That's also when the risk of a sharp reversal increases. I'll be looking to rotate some silver gains into gold at that point to lock in the outperformance. Trigger number 3, the $100 psychological barrier. If silver breaks 100 and holds for a week, I'm expecting a flood of mainstream media coverage, retail FOMO, and a potential acceleration to 115 or 120. But I'm also watching for a blow-off top. If we see 10% daily gains multiple days in a row, that's parabolic, and parabolic moves end badly. I'll be taking some profits into that strength. Trigger number 4, COMEX margin hikes above 30%. If the exchange announces another major margin increase, I'm sitting on my hands for 48 hours. I'm not selling, but I'm not adding either. Let the volatility settle, let the weak hands get flushed, then reassess. Here's my personal stance on physical versus paper. I'm not selling any physical metal as long as the premium divergence persists. Why would I sell at 94 when the US Mint is pricing at 173? The physical market is telling you the real price. The paper market is a lagging indicator that hasn't caught up yet. I'm holding physical, ignoring the paper volatility and waiting for convergence. Let me tell you what the analysts are forecasting because the range is enormous. UBS says 100 plus, gold silver is calling for 100 plus. Technical traders like Christopher Moylan are targeting 106 based on Fibonacci extensions. The consensus from Scottsdale Bullion and Coin puts the average 2026 price near 97 with a range of 65 to 100 and high-end outliers suggesting 120 to 150. Robert Kiyosaki, who's been vocal about precious metals, is calling for 200 near-term and 500 long-term, for what that's worth. My base case is 95 to 115 by mid-year. My bull case, if Greenland trade tensions escalate, if the Fed loses more credibility, if the LBMA hits delivery problems, is 120 to 150. My bear case, if we get a severe global recession combined with a strong dollar rally, is a pullback to 70 to 90. The risk-reward still favors being positioned. The downside might be 20 to 25% in a worst case. The upside could be 30 to 60% from here. And that asymmetry is exactly what I look for in a trade. Here's what I need you to understand as we close this out. The screen is lying. It has been lying for months. The paper price says $94. The US Mint says 173. The Shanghai market says 104 with 30% premiums. The lease rates say physical is impossible to borrow. The COMEX vaults say metal is leaving faster than it's arriving. All of these signals are converging on a single conclusion. The official price is wrong. It's a ghost. A relic of a pricing mechanism that assumed unlimited paper could substitute for scarce physical metal. That assumption is breaking down in real time. The miners are printing record profits. First Majestic just reported the best year in company history with 15.4 million ounces produced. Pan American is ramping production. The mining stocks have outperformed the metal itself because of operating leverage. These companies had all-in sustaining costs around $30. At $94 silver, their margins have exploded. The fundamentals say deficit. The technicals say breakout. The institutions say buy. The US Mint says 173. and the paper market says 94, like everything is normal, one of those is going to be wrong. And I don't think it's the mint. 5 days from now, on January 24th, 8.7 million retail investors are planning to descend on physical silver dealers simultaneously. The inventory cannot absorb that demand. The dealers are already struggling to source metal, the premiums are already stretched, and the mainstream financial media still isn't talking about it. By the time they do, the move will already be made, the opportunity will be gone, the premiums will be 50% instead of 20%, and everyone will be asking why they didn't see it coming. But you did see it. You saw it tonight. You saw the data, the deficits, the demand drivers, the breakdown in paper versus physical. You understand the mechanism now. What you do with that information is up to you. I'm not your advisor. I'm not telling you what to buy or sell. I'm just showing you what I see on my screens and what I'm doing with my own capital. The numbers don't lie, but the screen does. The vaults are emptying. The premiums are screaming. And the sovereign mint of the United States just told you silver is worth $173. Are you going to believe the ticker tape, or are you going to believe the math? Stay sharp. Watch the data. And if the 24th lives up to its hype, you'll want to already be positioned before the rest of the world figures out what's happening. I'll be back with an update as things develop. In the meantime, keep stacking. Keep watching. And do not let the narrative distract you from the reality that is unfolding right in front of us. This is the moment. The structural repricing of silver has begun, and it's happening whether Wall Street reports it or not.